All right, good morning, everybody. We got kind of a double date here this morning. We got CPI on the one side, and then we've got jobs data also at the same time. So 8:30, we have the potential to see some pretty good volatility, which means we have the opportunity for the liquidity gap trade that I really like. It doesn't mean we're going to get it, but we're certainly in the running to have it. So we're going to jump through this really quick. If we don't get this, it doesn't mean we don't have a tradable opportunity. We can always trade something else. But if we do get this, well, I really like this trade. So the idea is at 8:30, we could get a really big candle like this. And notice when the candle opened, we really didn't go in the other direction, right? There's not much wick here showing an upward move. And we closed near the low of the candle. We didn't pull back somewhere near its half. This is a liquidity gap. I know you don't see a gap, you see a candle, but this is the gap that we want to close. So if we started here, we need to finish here. And we got there around 11 o'clock. So I really like this trade. If it doesn't look like this, I'm really not interested in it. I'll find something else to trade. So we have this opportunity throughout the day. There's always the chance that we'll get these kind of candles. The thing is, today and on CPI, non-farm payrolls, we know when we could get one. Because if it happens in the middle of the day, it often happens from some unknown news that hits. And then, well, we didn't see it coming. We didn't know it was going to happen. But on these event days, we do know where it could happen, and it gives us that opportunity. So this one is going up instead of down. Same thing. At 8:30, we got the news. We started moving in one direction. We didn't go in the other direction, and we closed near the high. We didn't pull back a long ways. Since this is where we started, is where we need to get back to close the gap. We got there at around 10:30 or 11 o'clock. Here's another version. This one is a CPI 8:30 print. We closed near the high, and then we based inside that wick. Then we continued to move, based some more. We got back there about 10:45, closer to 11 o'clock. So this is the play. I call it a liquidity gap. This is what we don't want to see. We kind of had a wick going in the wrong direction. Price closed way off of the high near the midpoint, and we got the gap closed in less than an hour. That's not the kind of trade that I'm looking for. Here's another example of what we don't want. There isn't much of a gap to close if price falls all the way back down to end the candle pretty much where it started. You know, that's like a massive doji. Not much of a gap to close. And in the very next candle, we closed it. So this isn't what we want. Same thing, big wicks on each side. This isn't what we want. It's another example. It's not what we want. So I mentioned you can get these in the middle of the day. On this day, we had events at 10 o'clock, which caused that big liquidity gap candle. And then at 12:30, we got hit with news, caused another liquidity candle. We got that one closed. And then at 3, we got hit again, dropped down, closed the first one, ran back up, and closed the last one. So you can get these all over the place. If you're not interested in trading it, that's cool too, because at the very least, if I can save you from trying to buy calls at the open on a day like this where we popped up, we're basing as we come into the open, and you think, oh, wow, it was really bullish. I'm going to buy some calls at the open. Yeah, how'd that work out? Not so good, right? So if I can help you avoid doing that, then, good enough. Same thing here. If you had seen that and you thought, oh, yeah, at the open, this is going to be great. I'm going to buy some calls. Yeah, no, that didn't work. Right? Or getting some puts here. That would have been a bad idea. So we have the opportunity today to perhaps get that candle set up. And if we don't get it, no problem. We'll just find something else, right? There's always another setup, another pattern. We'll do something. Markets are basically on wait at this point. They're waiting on the data. They're not going to get in front of it. And after the 8:30 time frame, we've still got a lot of other things going on, including an auction on the 30-year today. It's kind of a big deal, and a lot of Fed speakers. So you're going to want to watch the clock. We got auctions at 11:30 and auctions at 1. This 30-year is the one that I'm really interested in today. But as I've mentioned before, if we have auctions anywhere on the schedule, just assume that the other two locations also have auctions. So if we only had one showing at 1 o'clock, we would go ahead and believe that 11 and 11:30 also has auctions, even if there's nothing listed here. So many things don't get listed in this every single day, right? You can't get them all. We don't even need to try. We can just watch the clock. China says they're going to have a meeting on Saturday to really discuss these additional stimulus measures, but that wasn't clear enough and markets didn't really respond to it. So now they've provided additional information about Saturday's meeting where they're going to provide more information. That works great, right? They should have just went ahead and did it instead of hyping it up as, oh, we'll tell you more about it Saturday, but here's information to get you by until Saturday. There's going to be some changes coming soon. I think I've finally reached my limit with trying to explain to people what the average daily range is as opposed to the average true range. So yesterday I started working on an indicator that will do exactly what my ADR does, but it'll be an ATR. It's literally the exact same thing. The numbers will be slightly different, but it's going to look exactly the same. The lines will be red, they'll be yellow, there'll be a half and a whole. It'll literally be the same indicator, but it won't be an average daily range. It'll be an average true range. I give up. Call wall still overhead. We're waiting on spot gamma to provide the AM edition. Nice bounce off of the 10-day. We're holding still above the 10-week. Put wall volatility trigger and zero gamma all underneath this. I want more information on this call wall that moved, but we need to get the AM edition first from spot gamma, see what insight they have on this. Otherwise, we're holding between the two ADR lines. We don't see any hedging yet, so either they're already comfortably hedged or they don't see this as any sort of threat of an event. And the overnight volume is at 63. It's a little light compared to what we've seen earlier in the week, but still within normal ranges. The ADR lines, ADR half, since we haven't hit either side yet, both are on the table and we're basically flat. So there's no edge in projecting which direction we're going to go first. Plus, with economic data, you know, even if we were close to one side or the other, as soon as we get data at 8:30, pivot points won't matter, ADR levels won't matter, options levels won't matter. Nothing's going to matter except the flows that are coming in that moves the market when we get the econ. So let's get the econ first, then we'll lay out levels beyond that. We're comfortably above the weekly pivot point. Today's floor pivot higher than yesterday's. That's considered bullish. Price opened above the pivot. That's also considered bullish. And we're still above it, and that's considered bullish. Yesterday was an MDP. It's a missed daily pivot. And so far today, we have an MDP, which is a missed daily pivot. But today's doesn't count until tomorrow, just like yesterday's didn't count until the end of the day. Right now, we're just resting on the channel of that pivot, which is a wide channel. Wide channels imply that if we do attempt a breakout, that the breakout won't stick. Spot Gamma's gamma index was at a 2, positive 2, I believe. Scrolling back now to check so I don't misspeak. 1.5 on the positive side, which also implies that if we break out, the breakout won't stick, that it won't have legs and we won't continue to run. Now, having said that, yesterday's a really wide range. So the issue is if we're in a very narrow range, if yesterday was a really skinny, choppy, sideways day, and then we're supposed to stay inside that very skinny, narrow, choppy, sideways day, that would have implications because it would imply compression. But yesterday was a really nice expansion day, and that left a really wide hole here. So saying we're going to stay in the range, I mean, it's a really big range. Implying that we won't break out is saying we won't go lower than that, or that if we do, we'll come back in again. Okay, but that's a long ways off. On the other side of it, we do have 5850, implying that if we do run up and break out of yesterday's high, that we'll get into the liquidity zone up there, stall out around OCC and fall back in again. To define where that liquidity zone and OCC is at, just throw the fibs on it. That's our 5850 with an overshoot of 5862. I don't see it even getting into that overshoot, by the way. And since this is so wide, right, we're talking from 46 to 62. That's a really big zone. I want to tighten it up and just use the RTH. Now it's a smaller range to 58 instead of 62. It's not great, but it is a little more compact. So that'll give us the LZ here and the OCC here. Not really expecting to get beyond that without some sort of news or push or something, right? Price alone isn't going to do it. CPI could get us up there, or the 830 print, but then it would be a question of can we keep it? All right, so we built up some volume here yesterday. 58.32 cog line, not a surprise. We had our breakout of this zone, but we weren't able to keep it. Now we're getting a bit of a Busby after breaking this zone. So Busby is a phrase that I came up with because I got tired of the entire sentence that comes with this. So when you have resistance and you have price fighting that resistance and it finally breaks out, a lot of times we will come back and validate the old resistance and check it as a new support level before we continue the move, before we continue the breakout. That's a whole lot of talking when I could just say we're doing a Busby, right? So the word Busby is nothing more than a simple one-word answer for price hitting resistance, finally breaking out of that resistance, and then pulling back to validate old resistance as new support. The expectation is that the stronger the resistance, once we do get above it, the more supportive that level happens to be. So we're expecting it to bounce there, hold as a support level, and then retest these highs and try to go higher. If it fails, then obviously it wasn't that supportive after all, and we're going to come back in. It really only tested it yesterday. It wasn't like we've had multiple tests, right? If this had hit it and then that hit it there and that hit it there, and then we came up and broke out of it, well, that would have been a completely different circumstance, right? We would have had multiple tests of that resistance before finally breaking out of it, and we don't have that. This was our first time testing it. We punched through it. Still counts as a Busby setup, but we still need to follow through. By the way, the Busby only owes us back to the top. What you'll find, though, if you go back and look at trends throughout history, they started with price that was in a range. It broke that range, pulled back and validated the old resistance as new support before it began the trend that you found. So a lot of times, these really great trends started with a Busby. So while it only owes us back to the top, if we get to the top and we continue the run, well, it could be the start of a whole new trend. And that works on any time frame, by the way. There's no rules that say you have to do it on just one time frame. If we do break out of SPY's high of yesterday, we've got a flip point at 578. It's where we would go from being in a negative to a positive gamma state. We're resting on the zero gamma this morning at 576 and the volatility trigger below us at 574. Call wall at 580, and a 1 day's 1 standard deviation move is 582.85. That's what we hit yesterday, by the way. It's that 1 SD. And SPY does have a market maker move this morning. All right, 10-day, 30-minute volume profile with TPO. The TPO is still at 57.50 on the point of control. Our point of control on the volume profile has not moved. It's still at 58. Or I should say it hasn't moved down there. It's at 58. The expectation is that it'll fall down, but this is one big, massive D-shape profile with nothing really good standing out. I do believe it's going to come down here and match this one. As we lose these candles will have the greatest amount of volume, which stands to reason that the point of control will move down into that level. It's kind of the thinking at this point. That wouldn't really help us out other than give us a level really far off. If we're at 58.32 cog line, having the point of control at 58 or 57.50 isn't really helpful. It would be a bit of a safety net, just a very far away safety net. No VPOC from yesterday to grab out, and we really don't have much of a classic shape here. If we were looking for, like the capital P, after that sort of a run, having that classic P-shaped profile would make sense. But we had a lot of volume in that structure before we moved. So it's shaped more like a B, but in profiles, we don't have a capital B. They say that it's two different Ds, an upper D and a lower D. And then you focus on which D has the point of control in it. That would be the upper one. We've already cut through that level, so no VPOC. And as for the range, we can measure this, cut it through its half back. We can measure just the RTH itself and do that as a half back. But if we break this structure here, it's very likely that we'll go back to yesterday's open and that we could then challenge yesterday's low. We do have a disagreement this morning between TPO and volume profile. There were more trades taken up here if we're looking at the TPO, but there was more volume done down here. So we finally got through this range that we've been fighting against, trying to work on all of this liquidity. We finally got through it. Now we need to keep it. We can fade down into it to test it a bit like a Busby, but we don't want to get completely back inside this zone. So another way to think of it is Friday's close, we need to keep that. Or 5,800 is another way we need to keep that. $58.88 is the range high for the week. That's the weekly expected move. We're at 2.75% above the 10-week. That's a good spot to be. We're not overbought. We're not overextended. It doesn't owe us anything. We're not looking for any mean reversion on that higher time frame. This is just a really good spot to be. But that is the weekly. Put it on a daily. We're not even 1% away from the 10-day moving average. We're not overbought. Yesterday's move wasn't that big, and I think it closed at like 0.6%. We weren't even a 1% move yesterday. So it might have felt really big, but it wasn't that big of a move at all. We're not overbought. We're not overextended. No least squared methods, mean reversion, dot plot statistics, or anything else that says that we've gone too far and we need to go back in the other direction. We're not due for a correction. We don't even need a correction. We could move another 0.75 higher and we still wouldn't be considered overbought. We'd be on the edges of the range for sure, but we wouldn't be there. So don't think that it owes you some sort of move to the downside today just because of how far we moved yesterday. As I'm telling you, yesterday's move, it wasn't that big. It really wasn't. Looking at the things that are down this morning, if the benchmark that we're going to use is 0.5%, we've really got nothing to the downside except nat gas. Not much of a problem there. Looking at what's up, China ADRs and VIX. Well, that's not much, right? If we're looking for that broader rising tide scenario like we had yesterday, it's not here. So China ADRs, some crude. It says extended tech, but it's just an algo print. So, without any real flows there, we won't count that. Bitcoin up a little bit, but I mean, if you look at it, it's more of like a dead cat bounce at this point than anything else. That is my failed flag play, but it needs to follow through. So at this point, unless this Bitcoin can get through, say, even the half of yesterday, then there's nothing. And it still has the top of this range up here, $18 area. So it's got to get through all of that, then get the gap closed, then the other gap. Nothing, right? But it has the potential. It's getting started. But that's what we've got to the upside, which is basically nothing. No Mag 7, no consumer discretionary, the financials. We got nothing. Jets taking a little bit of a beat down. Nat gas, cloud computing services, which is just an algo print at this point. It's just that little dot right there. That's nothing. So we need some flows. That ain't it. So we'll ignore the cloud one. And SMH isn't down enough to meet our benchmark. So, and it's just an algo print anyways. We're stuck waiting on data. Once we get the data, we get closer to the open. You could do this sort of search through the sectors again. Look at the names that are up. How many names in the S&P are up? How many are down? How many names in the NASDAQ are up or how many are down? Doing that bit of a market breadth, right? But until we get the data that shakes everything loose, looking at it now would just be a waste of time. So short and sweet, watch the clock, be careful,